welcome back. You're watching Stockwatch, and joining me this evening to take your stock-related questions are Shane Watkins from All Weather Capital and Wayne McCurrie from F&B Wealth and Investments. If you'd like to send those questions to us, please email stockwatch@bdtv.co.za or on SMS at 41392 is the number. Wayne, Shane, good evening to you both. Shane, as you're not a Wednesday night regular, I'll start with you this evening. It wasn't a bad day at all for the JSE, and I wonder how much do we have the US inflation numbers to thank for today's performance, not only on the gains that we saw in the all-share index, but also the gains that we have seen now in the Rand?
Sure. Good evening, Julieta. So US CPI data came out at about 2:30 SA time today, and it came out at about 3.3%. I think that was a little bit lower than what people were expecting. And of course, lower inflation means that interest rate cut expectations are brought forward, and that is good for the whole world. I mean, essentially, the US interest rates determine global interest rates generally. And if we start to see rate cuts, and 2 rate cuts are now expected in the United States, one in September and one in November, and then probably at least 4 or 5 in the following year, between 2025. So, that will result, firstly, in lower rates, and secondly, a weaker dollar. And both of those are very positive things for South Africa and the JSE.
Yeah. Wayne, do you think all the gains that we've seen in the currency in the last couple of hours is due to the US inflation data, or the news actually that's just come out that the IFP is willing to work with the ANC and the DA in a national government? I imagine that's powering us up a bit as well.
Yeah, look, it's a combination of all of these things, but it is the US inflation data essentially at the end of the day. And I mean, as we all know, the Rand's been sort of let's call it in a range since, middle of last year. In fact, you could even argue the beginning of last year. It's been between sort of 18 and 20, and it goes up, over the 19, and it pulls back. And right now, because of the US inflation data, it seems to be going back to 18. Remember, we almost got there literally a couple of weeks ago. And then with the political uncertainty around the election result, the Rand weakened, now it's strengthening again. And, stuck record me again, but on a 2 to 3 year basis, fair value for the Rand's probably 17.50 to 17. As long as interest rate cuts come, as long as we get a commodity cycle recovery and the global economy picking up, and all of these things, all of these cyclical things. So, I mean, the Rand could still strengthen quite significantly from this level.
Yeah, let's hope so. Getting to questions, because there are quite a few, and there were quite a few results out today. And one of the results that came out was Multichoice, and they were horrible. Shane, I don't know if you had a look at them, but the question that's come through from a viewer is, should I sell my Patuminati shares, which is the BE Multichoice share that trades on the exchange, or should I hold out for the Canal Plus deal to conclude and hopefully a better South African economy? What would you do if you were in the viewer's position?
Well, look, the Multichoice results were truly appalling. Okay, they weren't just bad, they were terrible. I mean, if you think that 2 years ago the expectation was that this company would earn 10 to 12 Rand, a year ago the expectation would earn 8, and now they've come out and they've earned 5, okay? But that 5 excludes another 14 Rands worth of charges that they haven't put through the income statement, okay? So the actual earnings number is a 9 Rand loss per share. This company actually is sitting on a negative equity position. Absent a takeout by Vivendi or a dramatic improvement in trading conditions, in my opinion, this company is looking at a rights issue. So, I mean, Vivendi have offered you 125 Rand. The deal is likely to go ahead, but not certain. And so I would say, if the deal doesn't go ahead, the share will trade below 60 Rand,
sure,
in my opinion. So just on a balance of probabilities, I think I would take my profits and run. I mean, there's a firm intention, but, to be dead honest, I'm not sure if there's a material adverse change clause in the agreement, but it's never certain that the deal will go ahead. It requires regulatory approval from the Independent Communication Authority, from the competition authorities, from DTI. If this deal doesn't go ahead, there's significant downside in Multichoice, in my opinion.
Yeah. Wayne, would you agree? I mean, they talk about a negative equity of 1.1 billion Rand.
I know.
What does that actually mean? Look, that there is no... Is the company technically insolvent? Yeah.
They're technically insolvent. They've got a negative net asset value per share, a negative net asset value from quite a strong positive net asset value. Look, what's happened here is they've kitchen sinked the results because of the takeover. So they've written off absolutely everything. They've cleaned the whole cupboard and they've thrown everything, including the kitchen sink, at the income statement and the balance sheet. So this is quite normal. It happens quite often, actually, surprisingly enough, more so than what you realize. Is that like when new management takes over a company, they kitchen sink it. So this is quite a normal occurrence. Effectively, the price of the deal is it's almost there. I mean, it's trading at 110 rand somewhere around there, and the offer's at 125, as Shane said. You might as well take your money now because there is downside if the deal doesn't go through. Look, make no mistake, they've canvassed every single person possibly they could canvass, and they've got an army of lawyers that have gone through all of this, but there is still a chance that the deal may not go through. So, I mean, there's another 10%, 15% upside. The share price has performed obviously spectacularly well, but only because of this deal. So even with the shocking results that came out today,
Didn't
the
really
share price
move.
is unchanged because of the underpin of the
deal.
the actual deal.
Yeah.
So take your money. Why not? There's not that much more upside staying in them. They're not going to change their offer price.
Shane, you look like you want to say something.
Right, but look, no, I must disagree with Wayne there. These numbers are not kitchen sink. In fact, there's quite a lot of, let's say, profits in these numbers that are artificial in a sense as well. I mean, they pushed $1 billion or $2 billion of Showmax costs that could have been in this year into 2025, and they tell you that. They do decoder subsidies when you buy, when you join up with Multichoice. They subsidize the cost of the hardware. Decoder subsidies in these numbers are 2.2 billion rand less than last year. And that's because they pulled back on decoder subsidies because they know trade is so poor. There's also about another 1.5 billion of profits on foreign exchange contracts that crystallized in this period, which are one-off in nature. So in my opinion, these numbers are not kitchen sink, they're truly bad. I mean, they wrote off, it's small, but they wrote off 100 million rand on a little company called Bidstack that they only bought 12 months ago, and it's insolvent now. These are catastrophically bad numbers and bad outcomes generated by this company.
Yeah, okay, well then, I think it's quite clear, take your money and run. Because the alternative might be really pretty horrible. Talking about a company that has not had a horrible performance, that has just done phenomenally well, is NVIDIA. And the viewer says, what does our panel think about the prospects of a AI bubble? NVIDIA seems to be making cash profits, but how likely is it and the AI industry to maintain growth to support their valuations? Wayne, going to you. I mean, you've talked about how once competition comes in, NVIDIA may get knocked off its perch, but do you think we're already in bubble territory and the valuations are ridiculous at these levels?
Look, share prices and these share prices, the Magnificent Seven share prices can come off, but I truly don't believe we're in an overall stock market bubble. I mean, I know the performance, now let's just talk about the NASDAQ itself. I know the performance has been spectacular the last year and a half. But if you go back to the beginning of 2022, the NASDAQ index was 16,000. It's now 17,000. You know, people forget there was a 30-40% fall that happened in 2022. So you started 2023 on quite a low base. But everyone's measuring that performance as being spectacular. So that's the first point. Yeah. The market's actually not that high up since the beginning of 2022. You know, it's literally 1,000 points higher. You know, from 16,000 to 17,000. So just remember that first fact. Secondly, when you look at the overall valuation, now you can use a price earnings ratio or whatever you want to use. The market is on the expensive side, but it's a long way off the overvalued levels like the dot-com bubble and the global financial crisis and other stock market peaks that we've seen. Of course, you only know about a peak after it's happened. And thirdly, it's highly unlikely you're going to get an absolute catastrophic collapse in the stock market when you're going into a period of falling interest rates. That normally happens when you go into a period of rising interest rates, as what happened in 2022. It's exactly what happened there. The valuations came down. So in other words, this market is supported by earnings. And that doesn't mean it can't fall 20%. It could easily do that. And nothing else would change. Nothing would change, and the market could fall 10 or 15 or 20%. But the chances of a bubble and a 40-50% fall, I think, is highly unlikely.
I mean, Shane, do you see the industry, the AI, development of AI in particular, sustaining the growth that is necessary to sustain the current valuations?
Let me offer you a different perspective. There are three companies that are worth more than $3 trillion in the world, right? Microsoft, NVIDIA, and Apple. The total market capitalization of every company in China added together is under $4 trillion. So you've got to ask yourself, would I like to own NVIDIA or every company listed in China? And so I'm not really commenting on the NVIDIA valuation in isolation. I'm just saying that it seems insane to me that 3 US companies are so outrageously valued versus alternative investments. You know, I think we fully accept that China, the market has risks. It's not a democracy, it's a different legal system. The demographics are deteriorating. But still, I mean, you know, for the value that you can get, Microsoft is worth more than China and Korea added together. Would you like to own every company in China and Korea or Microsoft? I mean, no doubt Microsoft is a good business, but I just think that the relative valuations globally have got a little bit out of whack. I mean, the US market capitalization as a percent of total global market capitalization is about 65%. So in other words, 2/3 of the total value of listed shares in the world is in America, but America is only 22% of global GDP. Now, there are some factors that explain that, but it just does seem a bit extreme.
Quite a lot of results, as I said at the start, out today, including trading updates from PPC, Motus, and then results from Spar. The question on Spar, and Shane, I'll start again with you. The viewer says, Spar's first sends this morning, I wanted to short it, and then another sends after the market open was very bullish. Ended up shorting this one around 109 Rand. Any views from the panel? Spar shares jumped quite significantly today. Shane, would you be shorting this company in light of the proposed sale or the buyer that it actually has for its Polish operations?
So short answer, no, but I guess, you know, for all our industrials and financials, we'll know whether we should be long or short when we see what happens politically on Friday, right? I mean, if our political transition proceeds according to plan, then, you know, the market will rally. So that's kind of a macro answer. On a Spar specific answer, I wouldn't be shorted. I think the reason the market liked the shares is they said they're exiting Poland. Sure, write-off about 2 billion, but that money's gone. They seem to have concluded their litigation with the franchisees. They seem to be through the KZN SAP issue they've had, and they're guiding for an SA margin to return to 3%. I think the SA margin is already about 2% and a bit if you exclude KZN. So they said there's no rights issue. They even sort of hinted that they might sell Switzerland in addition to Poland once they've concluded the Polish transaction. So, you know, if they get the SA margins back to 3%, Spar could earn 15 Rand. You know, could Spar be a 15 PE share earning 15 Rand? Well, I mean, that's 225 Rand. The share's 110. I mean, look, the share was 200 Rand 5 years ago. So, I mean, could it get back to that? I think that there's a reasonably decent chance it could. And I mean, I also want to say that, you know, while the share was up 11% today, this has been a management team. Well, the previous management have also made terrible mistakes, and that's how they got themselves into this situation. The new management team are turning things around. But I think in some ways it speaks to how strong the Spar model is, that despite the best efforts of the previous management, you know, to damage this company in some way, but by bad decisions, The business has got through without a rights issue. Pick n Pay needs a rights issue.
Yeah.
It's still profitable. Pick n Pay is making losses. I think the Spar model is very resilient. And yeah, I mean, I think to answer your original question, I think it could be 100% upside in a reasonable scenario.
Wayne, do you agree? I mean, Shane, I'm not sure if I'm as bullish as you on Spar. I also think, KZN, anyone operating KZN is going to have some very interesting politics to deal with the emergence of the MK. I mean, if you looked at, inflation was 7%, but wholesale sales were only up 4%. Build-its were flat sales. Wayne, what did you think of the numbers X, the Polish sale, and if you look at South Africa versus Ireland and Switzerland?
Yeah, look, I mean, the South African operations, you exclude KZN. I mean, KZN is only standing out because of the big SAP implementation issue, and that was catastrophic. It's still not a major part of their turnover. So even if the politics go bad in KZN, it's not going to be a catastrophe for the business the way SAP was. The rest of the SA business is doing okay. Build It, same as Builders Warehouse, they're coming off a massively high base still from COVID. People have done all their DIYs, and that is a tough industry. There's not much building going on, and there's not much house alterations going on with interest rates where they are now, but that can change. I certainly wouldn't short the share. That I wouldn't do. Maybe they're better South African shares to buy than Spar if you want to go for South African shares. I think the banks offer a lot better value, maybe some of the life assurers. But this wasn't a bad set of results. Poland's going. I mean, the people in Switzerland can't carry on forever jumping over the border to buy stuff cheaper in Italy and then bringing it back because their currency is so expensive.
Yeah.
The England and the Ireland business is doing quite well. So they've had some exceptionally difficult problems. They've changed the management team, as Shane has said. So the share looks reasonable value. I wouldn't short it.
Yeah. Okay. And then there's a question from a viewer who says, my question is about building your own US share portfolio or just sticking everything into an S&P 500 ETF. He says, I've been paper trading shares since 2000, invested in South African shares, but since May 2021 have started investing in US shares, making mistakes, correcting those, etc. My portfolio stocks are weighted between just under 4% to just under 8% to minimize risk, and I have 20 shares. And then he has sent me a chart of how his portfolio is tracking. It's a Vanguard S&P 500 ETF. He says, I'm up 39% since May 2021, while the Vanguard is up 34%. It seems like a lot of effort to only have a 4.5% lead that could turn around as well. Is it time to take 200,000 Rand and build a trading portfolio and then just stick the rest into Vanguard, into the S&P 500 ETF? Shane, it is quite a lot of effort. What would you do?
Well, look, I think you must stay where you believe you have a competitive advantage. I will say that the thing that COVID did was it changed the way that companies engage with investors. And so prior to COVID, a lot of companies only had physical interactions, results presentations, AGMs, and so on. Now, almost every company in the world does a virtual presentation and maybe a physical presentation. So it's much easier now than before COVID to have the same level of information as any other investor anywhere in the world. I mean, we sit on the Pinduoduo results call, the Alibaba results call, the Tencent results call, I sat on the Tesla results call 3 months ago. I mean, you can engage in exactly the same way that an investor that lives right next door to that company is able to. So I think that the asymmetry that used to exist, geographically has gone away. And so I do think you could build a portfolio, from South Africa trading globally.
Wayne, what do you think?
Yeah, look, first of all, if you think it's arduous, don't do it. So don't just, if you must enjoy what you're doing, and it must be fun. And then carry on doing it. It sounds like the viewer is doing the right thing. They've got 20 shares. They're not concentrating the portfolio. They're getting some diversification. You learn all the time in investments. Every single day you learn. You make mistakes, obviously. I don't think it's a bad thing to carry on investing. But I'll just make one little caveat to that. Over time, it's extremely hard to beat an index, believe me.
Yeah. Okay. So maybe put most of it into the index and then keep some money for the fun, which, which I think a lot of us do. Then there's a question on General Motors and Walmart, and the viewer says, which of the two, if either, would the panel consider to be a worthwhile buy at this time? Shane, do you look at either of these two companies?
Not really. I mean, the thing is, so Walmart is the largest retailer in the world. I mean, some of the US retail shares have become very expensive. We were looking at a company called Costco the other day. Costco trades on a 50 times earnings, 50p, for a business that's growing 3 to 5%. And, I think there's been a wall of money that has gone into the United States, which has created some of these unusual valuations that Wayne has mentioned. I think you've just got to be sure that when you go into these companies that you're paying a reasonable price that you're paying at least a discount to what intrinsic value would be for either of those businesses. The car business, I think, is going to go through some tough times. I mean, there's a conversion of the traditional internal combustion engine manufacturers into electric. We know that electric car sales have stalled. Tesla sales were down in the last quarter. I think there are easier places to make money than either of those shares.
Okay. Wayne, how about you?
Yeah. Look, Walmart obviously, knows their game, but the share price has run hard and it's sitting out, I think it's a 30 price earnings ratio. So maybe you get some share price weakness, but I mean, over long periods of time, it's a share you want to own. General Motors, it's exactly the opposite. This is a 5-6 PE share. I mean, this is the value territory type of thing, deep value play type of territory on General Motors. So it depends on your investment style. If you like, good high quality companies that over time give you a decent return, even though the current share price might be a little bit high and you might stall for a year or two on that share price, then buy Walmart. But if you're that little bit of an adventurous type who likes the deep value shares, I mean, obviously there's bad news in the motoring industry. There's so much intense competition there. And, is it going to be battery electric or fuel cell electric or still internal combustions or hybrid, or is it going to be hydrogen internal combustion? You just don't know what the outcome's going to be, and there are going to be big casualties there.
Okay, very quickly, and Wayne specifically, and Shane, then I'll get your stock picks. A viewer says, is there a relation between the platinum price and US interest yields? Why did the platinum futures spike today? Related to the CPI numbers, I think, is what he's asking.
Yeah. Everything's related. It's all one big happy family.
Okay.
So the prospect of lower interest rates means higher economic growth worldwide, which should lead to a demand for commodities, and so commodity prices go up.
Okay. All right, getting to your stock picks this evening. Shane, what takes your fancy?
So I'm going to go with Old Mutual. Now, the Old Mutual share price is about 10 Rand 50. 5 years ago, it was 20 Rand. It is definitely not the best company in the world. It is definitely not in the best industry in the world. And I would also not characterize it as having the most energetic management. However, the embedded value of this business is about 19 Rand. And as I say, it's trading at 10 Rand 50. It's on about almost a 9% dividend yield. Management have said that there's about 2 billion of surplus cash that they're going to move to the center, and they could well do a share buyback. I just think that it's
just too cheap.
It's an average share that is ridiculously cheap, and I do think that if we have a benign outcome politically, and we have on top of that lower interest rates, as Wayne said, financials will do the best.
Yeah. Okay. So Old Mutual for you. Wayne, how about you?
I'm going for Naspers. I mean, the same thing we've been discussing the whole time. Even though the share, and obviously Tencent has run, there's still big upside to emerging markets and to Chinese shares and the Chinese market in total. So I'm going for Naspers. I mean, I think I picked it a couple of weeks ago or a couple of months ago as well. It just does look cheap. They came up with a trading update that looked okay yesterday. So yeah, go for Spars.
Okay, gents, that's where we'll leave it. Thank you very much for joining us this evening. Shane Watkins is from All Weather Capital. Wayne McCurrie is from FNB Wealth and Investments. The questions that we didn't get to this evening, Zanati will tomorrow night, so apologies for not getting to those. Up next, we have the close. Stay with us.